everyone. This is Vishal from Equity Guru, and let's talk about the equity markets here today. As I am recording this, the stock markets are testing quite the significant technical price level, in my opinion. We talked about this breakdown in previous videos and in previous articles, this trend line breakdown, this close below the 4,500 zone, the subsequent retest attempting to regain 4,500, that major sell-off here at the mid-August of this year. And currently, the equity markets or the S&P 500 here is making a nice rebound and is back again, retesting that 4,500 zone. So why is this important? Well, it's important because not only is this, a previous resistance zone, meaning, this is where you expect sellers to be, but it's also the current lower high area that we were working with, which means if the S&P 500 can get a strong close above this 4,500 zone, then this current downtrend or this move that we saw, beginning at the end of July to mid-August here, all of this downwards move was not the beginning of a new downtrend, but actually just a correction phase in this major uptrend going back to spring of this year. However, where things get interesting is, I've talked about this and many other traders are talking about this. There is a bit of an outline of a very important technical pattern called the head and shoulders, which tends to be printed at the top of a market and signifies, a topping and overall trend reversal. It gets important or it gets interesting because September historically tends to be the worst month for the stock markets, and we are heading into the month of September. But if the market can get a close, as I said, above this 4,500 zone, technically it would be a very, very significant breakout. And you can see here on the 15-minute, we are still moving up slightly. You are seeing signs of sellers stepping in, but the buyers continue to bid the market up. We are seeing some hanging man candles here, so we will see what happens going forward. But as I said, 4,500 strong daily candle close, and the markets, of course, as I'm recording, are already closed. So it is really now up to Wednesday's price action candle to give us that major trigger. Let's take a look at the Nasdaq. Very, very similar, although you could maybe argue that we have confirmed a strong breakout here as well. Some may argue that technically the neckline is right up here. And again, this is why I like to use zones, right? I never just say one level. I like to use zones because that's what support and resistance is here. But I think the Nasdaq has made quite a substantial close with today's candle. And to me, it's looking quite bullish here for the equity markets. The Dow Jones also closing above its previous lower high. So it looks like, all these markets looking very, very bullish. One other thing is adding to that bullishness, and that's this major sell-off, which we just saw here today in the bond yield. So you're seeing a big drop here in the 2-year yield. You're seeing a big drop here also in the 10-year. Quite significantly on the 10-year is because we were just retesting a broken down zone, and we've actually closed below that. So yields here are beginning to drop, and this is quite important because on Friday last week, we heard Fred Powell talk about, the Fed is not done with its battle against inflation. There is a chance that there might be more rate hikes to come, in the future. A lot of the market is just perceiving that as one more rate hike, not in the September meeting, but maybe in November or in December, right? They're not really thinking of it as multiple rate hikes coming down the road. And that is because, if you look at the inflation data, it is beginning to fall. It is below 4% now on the US side of things. And this data actually, caused a bit more bullishness. And it is that the job openings have dropped in July, showing a cooling labor market. And, some of you might be saying, okay, that doesn't make sense. If people are losing jobs or there are not many jobs coming here, why is that stock market positive? That's because, the Fed has been talking about the labor market and the robust labor market and using it as using it as one of the factors that it's continuing to raise interest rates because they're not seeing any, slowdown. And technically, the Fed wants to cool, the economy down, right? Because inflation includes money velocity, and they really need to sort of contain that. Whether that means they have to hurt people or they'll have to see the economy contracting a little bit. That's what they have to do with their tightening, and this data is actually fueling this, as it says here on Reuters, interest rate optimism that the Fed is likely very near the end of its cycle because the labor data is cooling, indicating that there is some weakness in the labor markets. And I think going forward, if we see that retail sales number also begin to drop, there would be more signs that this slowdown or recession is coming, and the Fed will look at that as okay. Now we can maybe tame money velocity, and we will not need to raise interest rates much higher. And you're seeing that impact here on the yield markets and subsequently on the equity markets here as well. I just want to show you guys here the FOMC tool, CME Fed Watch tool. So the next meeting is in September in 21 days, 21 hours, and 37 minutes. And you can see here that 86.5% of the market believes there's going to be no change, whereas 13.5% believe Fed will hike by 25 basis points in September. So right now, the market is technically pricing in no rate hikes. And generally, the central banks do not want to surprise the market. So if you do see the Fed surprise in September with the rate hike, then you see quite the volatile reaction in the stock market. But as I said, the Fed is still not as hawkish as they were at their, well, I'm talking about Jerome Powell, referring to his Jackson Hole speech, not as hawkish as he was the year before, but still leaving that door open, saying that there could be more rate hikes. We are sort of data dependent, and that data, of course, is that CPI data. I would also include the labor market and the retail data there as well, retail sales data. And the Fed is still saying that the battle against inflation is still on. And for some of you, that read economic history, a lot of people are talking about the mistake the Fed made back in the 80s with inflation is that they began cutting interest rates a bit too early, which allowed the economy to not really cool down but continue. And of course, inflation was dropping, but then it picked up again, which of course then forced Volcker to raise interest rates to what was it, 19 or 20% at that time. But of course, there's other things going on with the price of oil and such. But speaking about oil, I think that's one of these outliers to watch for. And I've talked about this in previous videos as well. There is a chance that we are going to see the oil markets begin a new uptrend. You are seeing a bit of a flag pattern here as well after a bit of a move higher, after we broke above this range actually in early July, which I thought was a very significant pattern. And then finally another breakout here near the end of July. But oil is breaking out of this channel here. And I'm watching this 81.40 zone because that is the lower high that I'm working with oil. And if we can get a close above that, that would be quite bullish on oil. And, some people are saying that this is geopolitics. Some people are seeing this as the economy is actually not slowing down. And there's going to be this demand for oil. But remember, if oil prices do go higher, then fuel costs are going to rise. Transportation costs are going to rise, and businesses might have to, pass down those extra costs to the consumer by raising prices, which would mean that those inflation numbers might surprisingly uptick. So this is why I think a lot of people here are watching the price of oil, and as the Fed has said, they are data dependent, so they aren't really saying they're going to, continue to raise rates, but they're going to watch. Or they're going to keep an eye out on that data. And right now, the market is seeing, the data positively, seeing that, okay, the labor market is slowing down, inflation is coming down, which means the Fed is likely not to raise rates anymore. And they are at the end of the rate cycle. And you can, see that with the move in the bond yields, which turning out to be positive for the stock markets. But I will just say that major outlier would be that price of oil and how fast that price of oil is going to move, and what that could do to surprise the markets with higher inflation data points. But as I said, very, very bullish here on the equity markets. Nasdaq and S&P 500 look like they're about to break out and cause false breakdowns here and continue their move higher. And the Dow Jones is doing the same. And I think the Russell here as well, quite an important resistance zone that it is testing here as well. So I might keep an eye out on this on the next day of trading, because the Russell just tends to lead the other markets. But yeah, as I said, quite positive price action on the markets, important lower high levels being tested right now, and the bond market or the bond yields are rejecting major resistance zones, just increasing the chance of markets continuing higher. So that's it for me, folks. Let me know what you guys think about where the markets are going. Is this the major buy the dip opportunity, or will September continue to be, a negative month for the equity markets? Be sure to like the video, be sure to subscribe, and I'll catch you guys all in the next Chart Attack.